So let's start. So to that, I'd like to invite Jin Kao to present the work Banking on Deposits Relationships, Implications for Household Problems in the Lower Market. Jin is from Norges Banking, and Jin will have 20 minutes to present.
Excellent. Thank you very much, Mr. Chairman. Thank you for having me here. So this is a joint work with my Norges Bank colleague. Is it on?
Yeah, you can.
Okay.
Close to you.
This is a joint work with my Norges Bank colleague, Emilia and Cedric from Q11, who is going to be on job market this year. So this paper is motivated by our interest on deposit accounts. So usually in economic research, people don't have a lot of interest of deposit accounts, in the sense that people always think deposits are boring. You know, they just sleep in the deposit accounts unless there's any extreme events like a bank run. Otherwise, people don't have much attention on deposit account. But for us, deposits are interesting. Suppose you have a deposit account in a bank. The bank can actually observe your cash flow, and actually using the observation on cash flow, the bank can actually infer your financial information or even credit quality, right? So in this sense, there is information on credit quality of the holders of the deposit accounts. So we want to reveal the information content of deposit account through the lens of relationship lending. So in economic research, the typical problem in relationship lending is the so-called hold-up problem. The issue is when you enter a lending relationship with a bank, basically your credit information becomes private information of the lending bank. So let's call him an insider bank. And then this actually makes it difficult for the borrower to escape the relationship and find an outside lender, call it an outside bank, because for outside bank, they don't know your credit quality, so they can't give you a proper term of the loans according to your credit quality, right? So this actually makes it difficult for borrowers to switch to outside bank for better terms of loans. And knowing this, actually for the insider banks, they actually don't have any incentive to offer you favorable terms in the loans. So this is the so-called hold-up problem. And in this paper, we basically reveal, well, if you have a deposit account in an outside bank, sometime before you switch to an outside bank, and to let outside bank learn about your financial quality, and then after you switch to outside bank, you can actually get a very favorable terms in your loan contract. So this is basically what we do in this paper. So let me give you a brief summary about what we did in this paper. So we use a unique data set on both deposit and lending relationships of all firm bank pairs in Norway. And we find some new insights about the structure of firm bank relationships, such that for many firms, about 20% of all firms, they actually has a deposit relationship with outside banks. And for firms who are able to switch to outside banks, more than 40% of them actually had a deposit relationship prior to switching. So these evidence basically reminds us there is something to do with deposit relationship in loan switching. And we formally analyze how outside deposit relationships affect the likelihood of switching, and also how this affects the loan terms receives upon switching lenders. So we found basically by having a deposit relationship with outside bank increases the likelihood of successful switching by about 8 percentage point. So this basically increases the switching probability by 1/3. And also by having a deposit account with outside bank, this reduces your loan rate by about 60 basis points. This is more than 10% of total lending rate, which is substantial. So our study provides a novel evidence that deposit relationship affects the lender's competition by facilitating lender switching in terms of revealing the information of the lenders. And also our results reveals that information friction plays a very important role, and we provide support to reforms that facilitates information sharing among banks. So for the sake of time being, let me skip the literature review. So let's come to the research that we did in this paper. So we first started looking at the first set of data, which consists of all firm-bank relationship in Norway in terms of deposits and lending coming from Norwegian tax authority. So basically, the Norwegian tax authority has the access of all firms' balance sheets in terms of their loan and deposits. And this basically covers a 20 years history, 180 banks, about 250,000 firms, and 500,000 relationships. So we define having deposit relationship by saying that the depositor has deposits in the bank in the last 1 year, and the same applies for lending, that the borrowers has loan with the bank in the last year, and switching loan basically means in the last year you basically switch from one bank to another bank. To give you some graphical illustration, so in this chart you can basically see firm A is borrowing from bank 1, 2, 3, and in the last year firm A has renewed borrowing from bank 1 and 2, but for bank 3 it borrowed from bank 3 a long time ago but renewed in the last year. So in this sense, because the gap is long enough, we basically regard the relationship in bank 3 as a new relationship, because the time gap basically means the information is basically missing. So bank 3 is regarded as a switching lender, but for the bank 1 and 2, we treat them as inside a bank. So this is how we define inside and outside banks. So the stylized fact we found in this data set is about 20 to 40% of firms actually have deposit relationships in the outside banks on top of their own relationship inside banks. And for those borrowers who manage to switch to outside banks, as you can see from this chart, about 40% of them actually had a deposit relationship with outside bank prior to switching. So in a nutshell, it seems that the deposit relationships seem to play a very important role for the switching borrowers. And to make more precise empirical analysis, we switched to a second data set, which is provided by a Norwegian Financial Supervisor Authority. So this is more or less the credit register in Norway. So the reason why our main analysis is based in this data set is this data set contains more information about all the loan contracts, so which provides more opportunities for empirical testing. But the downside is it covers a shorter time horizon. So it's 6 years, 2014 to 2019. It has 115 banks, about 75,000 firms, with a total about 100,000 relationship. So let me skip the summary statistics and let's come to the questions we are asking. So the first question is, does having an outside deposit relationship increase the likelihood that borrowers successfully switch to an outside bank? Well, basically we regress the switching outcome, whether you switch or not, on whether you have a prior deposit relationship with outside banks at the time of switching. So in the results, you can basically see by different settings, the having outside borrowing deposit relationship actually increases the likelihood of successful switching. And of course, you might say, well, switching is an endogenous decision, right? Firms switch to lenders for some reasons. So this is not random. So in order to deal with this endogeneity issue, we explore the threshold of deposit insurance in Norway. So in Norway, basically deposits up to 2 million Norwegian kroner is insured. So that basically means for firms who has deposits above this threshold, they do have the incentive to switch to open another deposit account in another bank. So we explore this discontinuity by looking at what happens at the threshold. You can see above this threshold, the depositors do have the incentive to create a deposit account in another bank. So by more formal analysis, using the RDD approach, basically we found above the threshold, firms are more likely to create deposit account with another bank, and this indeed increases the chance of switching loans for these switching depositors in the future. So that deals with the endogeneity issue of switching. And the second question we are asking is, does having an outside deposit account improve the lending, the terms of loans after loan switching? Well, of course, we would want to compare the loan rates offered by outside versus inside banks for the switchers with versus without prior deposit relationships. But unfortunately here in the credit register, what we only observe is the outcome of the lending relationship. We don't observe the unsuccessful loan applications, right? So this is a typical challenge by looking at the loan relationships. So in order to deal with this missing information, we follow literature by using a matching model to generate appropriate counterfactuals. So basically we compare the switching loans to very similar comparable other loans and see what is the role of prior deposit relationship. So basically we matched the switching loans I to a comparable loan MI at the time of switch, and we compute the spread between these two loans and see how this spread depends on the prior deposit relationship. So what is the matching loans? Well, the first matching loans that we choose are the comparable non-switching loans in the inside or outside banks. So they are so similar in terms of the firm characteristics, in terms of the loan characteristics, but the only difference is they are not switching loans. But of course, you might say, well, this is not an appropriate match because switching is an endogenous decision, right? So you can't compare switching loans with non-switching loans. Then we have a second set of matching loans, that is the comparable switching loans. So we compare switching loans with switching loans. The only difference is some switching loans have prior deposit relationship before switching. But of course, you might argue, well, the difference between those switching loans might be contingent on the firm level characteristics, right? And you have to control for that. So to deal with this issue, with this concern, we moved to the third matching strategy by comparing the loans from the same switching firm. So we compare the same firm's switching loans with the rest of the loans which did not switch, right? Just to deal with this concern. So to give you a clear presentation, so first we match the switching loans with non-switching loans from the same inside bank. So that is, those loans are from the same inside banks, and some loans are switching loans. And for those switching loans, some of the borrowers had a prior deposit relationship. So we compare these terms of loan after switching. And alternatively, we can match the switching loans with non-switching loans from the same outside bank. So the idea is the same. These are loans coming from the same outside banks, and some switching loans, in some switching loans, the switchers had a prior deposit relationships for comparison. So in terms of the loan spread, as you can see in the results, so for the switching loans who had a deposit relationship prior to switching, there is a substantial discount, meaning that the switchers do gain from switching. And if we regress the spread on the dummy variable with prior deposit relationships, you can see having a prior deposit relationship does increase the discount after loan switching. So the second switching model is we match with the comparable switching loans. So they are loans switching from the same inside bank to the same outside banks, but for some switching loans, the borrowers had a prior deposit relationship. And you can see, well, by having a prior deposit relationship, the switchers does gain an extra discount in switching. And what is more interesting is the second column. So basically, we compare the switching loans. So some switchers had a prior deposit relationships, but some switchers had deposit relationship after switching. So we've still found a difference between these two kind of switching loans, which tells us the timing of having a deposit account is important. You have to create deposit account before switching so that the outside loans, the outside banks have the opportunity to know about you, right? So it is not useful if you create the deposit account after switching, right? That's too late. So in the end, we explore the mechanism behind our results. So basically, the conjecture is the deposit account contains the information of the borrower's cash flow, so that the lending banks can actually infer the credit quality of the depositors. And by knowing that, outside banks are actually able to compete with inside banks on a level playground, right? So this facilitates loan switching, also enables the switchers to enjoy better terms of loans after switching. So to test this, basically, we found, well, the probability of switching increases in the information flow underlying the deposit relationship. So basically, the probability of switching increases most for depositors who have a longer deposit relationship with outside banks, or depositors with more deposit accounts with outside banks, or depositors who shifted a larger share of their deposits to outside banks, so that outside banks can know you better because they can see most of your transactions. And the most important is we found this effect is most prominent through creating a transaction account, a deposit relationship with outside bank. Because alternatively, you can actually create a term deposit account with outside bank. But with a term deposit account, basically, the outside bank only observe a constant number, right? It does not know more about this constant number. So we basically show it is more useful if you create a transaction account so that the outside bank do observe your transaction records. So this, again, is applying to the terms of loans. So basically, the switchers enjoy a larger discount for those switchers who had a deposit relationship longer or larger or in a transaction account. And also our results are more prominent for the situation with more information frictions. So our result is more prominent for single bank borrowers, which basically means these borrowers are deeply stuck in the relationship, right? They are basically more subject to hold-up problem. So our suggestion by having an outside deposit account is more helpful for those guys. And also for those borrowers with longer inside relationship, again, you are more stuck in the relationship, or with young firms, which you have more information uncertainty, or when you are in a high bank competition relationship where the information sharing is more prominent. And this, again, as we show, driving the results in having discounts for those switching borrowers. So I don't have much time, but I think the last result is also interesting. So let me have a few more seconds. So basically, in the end, we show by having an outside deposit relationship help the outside banks to better estimate the probability of default of the switching borrowers. So basically, what we find is we regress the switching banks' assessment on the switcher's probability default, and we want to see how much this is conditional on the fact that some switchers had a prior deposit relationship. So the nice thing in Norway is, in Norway, all firms have a public credit rating. So of course, the public credit rating helps the switching banks better assess the risk of the loans. But if you have a prior deposit relationship, it actually provides more power of switching banks to better assess the riskiness of the loan. Okay, I see I'm running out of time, so let me quickly wrap up. So basically, we uncovered the information content of deposit relationships, and we show that by sharing the transaction information, outside bank can better compete with inside bank, and this would enjoy the would help the switchers in terms of better terms of loans, and we provide support for the reforms that facilitates information sharing between banks. Thank you very much.
Thank you, Jim, for your insightful presentation. So I'd like to invite Leandro Maciel from University of São Paulo to make comments about the work.
So thank you very much. Okay. So thank you very much, Jean, for your presentation. And I would like to thank the opportunity of reading your paper and also providing this discussion. So I will briefly give my takeaway of the paper. So in general, the work examines how deposit relationships between firms and outside banks mitigate hold-up problems, essentially evaluating how it affects information asymmetry. And the main findings using data from Norway are rich data, by the way. The authors show that the firms with deposit relationship, with previous deposit relationships, they have are more likely to switch lenders. And also they can get better loan terms. So I would like to congratulate Jim for the very nice paper. And here I give some key contributions. Of course, the paper have a lot of more contributions, but essentially the main contributions are that the empirical evidence on the deposit relationship enhance lender competition, and also deposit relationships, especially longer, deeper, or transaction-based ones, provide outside banks with more valuable information. They can get more aggressive bidding as well. And finally, the paper suggests that reducing deposit stickiness can can diminish hold-up problems. So it's a very nice paper. Here I bring, Jim, some very few comments. Essentially, there are more questions than comments. The study focuses on Norway. So we have a particularly banking structure. So I would like to know, how do you think, how can we generalize the results for other type of economies with more or less concentrated banking sectors, or also with stronger or weaker deposit insurance systems? The second question is, what do you think about the long-term outcomes when a firm switch the lender? What about the probability of renegotiation, the frequency of renegotiation? How about the default rates? And how do you think they differ from switchers with or without this prior deposit relationship? And finally, I would like to know, what do you think about the difference among banks? Do you think that smaller or less efficient banks can benefit more or less for this previous deposit relationship, or also banks with more advanced technologies can benefit more about this previous deposit relationship? So that's my question. Thank you again for the opportunity. Very nice paper, Jim. Thank you.
Thank you very much. Thank you very much, Leandro, for the nice comments. Should I respond first? Yeah. So first for the generalizability, Norway can be special, but I think our banking system has a lot of similarity with many countries in the world. So we do have a few large banks who account for a larger share of the market, and we also have a lot of regional small banks which play an important role in the regional economy. This is very much comparable with a lot of continental European countries, especially like Germany or France. Also, I think even with Brazil, we are similar, have a few large banks, but for regional banks, they also play an important role for the regional economy, right? So I think it is comparable with many countries. For a banking system with a more concentrated structure, I think the general message would still apply, because as long as you have information asymmetry between inside and outside banks, right? So as long as you had more than one bank in the market, basically the message would apply. And then a second question is about the outcome. So what happens after you manage to switch? So we have this in our appendix. Probably our paper, I must confess, is really too long. So we actually have the test by showing what happens after you switch. So of course, after you switch and then you start a new relationship, and then of course with time going on, you get stuck in the new relationship as well. So this is not a surprise. But what I found interesting is basically it takes about 4 years for the lending rates to reverse to the previous level of the previous relationship. But still, 4 years, I think it's quite some time for the switcher to enjoy. And also, what I found interesting is for those switchers with prior deposit relationship, their reversing cycle is actually the same as those switchers without prior deposit relationship. So this evidence is basically telling us, well, this is probably more or less an information channel instead of the so-called, many people claim this is probably because of cross-selling, right? So the outside banks approach the borrowers by offering a bundle of deposit and loan accounts and try to attract the borrowers. But our evidence, this is not the case. So basically, whether you have a prior deposit relationship or not, basically you suffer the same cycle. After a few years, you are again stuck in the same relationship that you have to try to escape with the next renegotiation. And for heterogeneities of banks, smaller versus smaller and less efficient banks, I think it's definitely helpful for those banks, especially for those small regional banks. We know smaller regional banks, they have a lot of duties. They know more about the regional borrowers, but they also have efficiency issues, right? They are less efficient. They are not capable of processing financial information. So this actually makes these banks in a bad position in terms of information asymmetry. So again, if this is the case, then by facilitating information sharing through deposit channel or through other type of policy reform, like the open banking reform that Tong is going to present, that would definitely help the smaller and less efficient banks, as I can see. Thank you.
Thank you, Jean. I'd like to open to the audience. If anyone would like to make any question, please raise your hand and turn on your microphone. Anyone? So I would like to make a question to open.
Yes,
Jean, along your research, have you identified any variable that can cause impact on the benefits of this information flow? For example, I don't know, data quality or unified taxonomy of the information, because different banks have different taxonomy about the same concepts. I don't know, like to have identified along your research?
We cannot see very much about that because in our data we only know whether you have a deposit relationship with outside bank or not, and how much the relationship is and how long the relationship has lasted, right? So basically we don't know more than that by knowing, for example, how much the banks can read from the deposit relationship. That is something that we can't observe. We wish to. Thank you.
Thank you. If I like it. Anyone has any questions? Please, Zé Renato.
Hi. Here in Brazil, and also for Bolivia, there is an evidence that after this initial lower interest rate, as you found, that to capture the client, the banks start to increase the interest rate in the long term.
Right.
Do you have this in your appendix that you mentioned?
Yes. So
okay.
we found it. So basically, the loan rate will gradually reverse, and after 4 years, basically, it will go back to the previous level.
Okay. Interesting.
Thank you.
Thank you. Anyone else? If not, I'd like to now invite Leandro Maciel from University of São Paulo to present his work that called, I will try to translate, registrars. Here, okay, I only have this. Registry entities and spreads the impact of the registration system on credit card receivables and discounting in Brazil. Please, I would like to, you can start, Leandro.
Okay. Thank you very much, Aristides. I would like to take the opportunity of presenting this paper here. Essentially, this paper evaluates the impact of a new policy in Brazil that was implemented in June 2021 that creates new market infrastructures that is called registry entities. They work essentially as trading repositories. They aim to record and monitor credit card receivables and also other kind of receivables. And in this paper, we are trying to investigate which was the impact of this policy on the spreads of a particular type of credit, especially the credit card receivables discount or credit card receivables anticipation. And this work was done with my colleague, João Bragança, that works in one of the major registry entities in Brazil, Central de Recebíveis, SEC. So here I have the outline of my presentation. I will first discuss the theoretical framework about this new policy, which is essentially by promoting competitivity in this market, and also provide some institutional context about how this registry system works in Brazil, and then the methodology, which is a simple diff and diff estimation, and finally some results, the main important results, and finally the conclusion. So we have common sense in the literature that advanced credit markets are characterized by high competition, by high transactional security, and high transparency. And when we have all these features in the credit markets, the cost of funds are generally lower, so we have a high liquidity, so in general, we have a more efficient capital allocation. So most of these studies agrees that competition plays a key role by reducing the spreads and promoting economic benefits. So we are working in this type of framework in this paper. In Brazil, particularly, we have some issues with competition. For instance, in 2023, all the credit operations, 58% of the operations were handled by 4 major banks. So we have low competition on market, we have higher switching costs, we may have also some hold-up problems. So we are here to evaluate a new policy that aims to provide more competition in the Brazilian market, which was the creation of this registry system by creating new market infrastructures, which are called the registry entities, which are essentially trading repositories. And we are here to evaluate, okay, what is the benefits from this new policy. Moving to the institutional context about the creation of this registry system, among the electronic payments in Brazil, as well in many other countries, the use of credit card is widespread. In Brazil, by paying with credit cards, we can use 2 different modalities. The debit modality, when we pay some purchase in debit modality, the funds are going to be settled to the merchant on D+1 or immediately, and we can pay in Brazil by using the credit modality. So we can pay our purchase in terms of installments. So we can pay in 1, 2, or more installments. If that's so, the funds are going to be settled to the merchant on D+30 days, D+60 days, and so on. So by paying with credit card, a credit card receivable is generated to the merchant. So it means that sales are not readily available to this merchant, and for some companies, especially small companies, this can result in some issues to cash flow management. So sometimes these merchants have to anticipate these sales. So how they can anticipate these credit card receivables? They can anticipate by paying a discount, an interest rate or a discount fee. And this type of credit operation in Brazil is called credit card receivables anticipation. And this is a very important type of credit, especially for small firms, for commercial firms and retail. And we have an outstanding balance in September 2024 of almost 100 billion of reais. So this type of credit operation, the main lender of this type of credit operations are the merchants acquirers. So in 2021, the Brazilian Central Bank promotes a new policy that was issued in July 2019 with some rules for receivables registration and also some rules about the anticipation of these receivables. And the basic idea was the creation of new trading repositories, this registry system that works as a market infrastructure to record and monitor all the payment schemes involving receivables, especially for credit card transactions at the beginning of the creation. How about this, how this ecosystem works actually? So suppose we have a merchant, so this merchant makes a sale. By making a sale, a transaction is generated. So the merchant acquirer now has to register this operation on this new created registry entity, this new trading repositories, and now the merchant can anticipate these receivables, for example, with a financial institution. So this merchant goes to a financial institution and negotiates the receivables discount, the anticipation of these receivables, and now this financial institution can go to this trading repository and evaluates how about the schedule of the receivables from this merchant, and also the merchant can transfer the ownership of this receivable to the financial institution by making the anticipation credit operation. And if that's so, the financial institution register also in the registry system, and now the registry system can establish the settlement with the acquirer. So the acquirer now will settle the funds directly to the financial institution. So in summary, essentially is a book entry system that aims to improve security, to reduce fraud by using the same receivable for different credit operations, and also to enhance transparency. But what changed with this policy? Before the registry system, merchants can only anticipate via their own acquirers or also with financial institutions that have some kind of partnership with their own acquirers. But now, with this new registry system, the merchants can anticipate with other acquirers and also with multiple financial institutions. So with the creation of this new policy, they can anticipate with more agents, so provides more competition in this credit card discounting operation. So we suppose that the creation of this new registry system can reduce switching costs, enhances competition, improve competition, and also lower information asymmetry by gathering all the information about receivables on this registry system. So the main research hypothesis here is that the creation of these trading repositories have reduced the spreads for credit card anticipation as a consequence of a more competitive market. So moving to the methodology, we can see this policy as a shock that affects, especially at the beginning of the creation, credit card receivables anticipation only. So we can see this policy, we can treat this policy as a quasi-natural experiment, so we can use diff and diff approach. So essentially we estimated a standard diff and diff approach, and here for us Y represents the spreads. So we have the spreads for our group of interest, which is the credit card receivables anticipation, and also we have our control group for other type of credit operations. And here, X represents some control variables that explain spreads in Brazil. And the main coefficient of interest here is beta 3 that captures the impact of this shock, of this policy on the spreads of credit card receivables anticipation. So we are interested on the significance of this parameter, and also the signal. We expect that beta 3 is negative, meaning that spreads for credit card anticipation are lower after the creation of the registry entities. Moving to the series that we use it, here we have the temporal evolution of the interest rates for the different credit operations we consider in this work. The red line represents the spreads for credit card receivables anticipation. The remaining ones are the spreads for our alternative, for our control group to perform the analysis. And here we have two temporal spots that are the release of this new policy on July 2019, and also the date of the implementation of the registration system that was in June 2021. So moving to our empirical results, we estimated our different equation for different specifications. Here, the fourth specification is the more robust one, since it accounts for control variables, for fixed effects, and also for seasonality. And we can see that for any of the specifications, the beta 3 parameter is significant, and for all cases are negative, meaning that in comparison to the control group, after the creation of the registry system, spreads for credit card anticipations are lower. To have an idea how much is lower, the average spread before the registry system for credit card anticipation was 50% per annum, and this moves to 3% per annum, so it's a huge decrease on the cost of this type of credit. In relation to the control group, this decrease was about 9% relative. We also investigate the shock as taking not the day of the implementation of this new registry system, but taking into account the day of the release of this new policy to evaluate whether or not the market are anticipating the consequence and also changing the opportunities for borrowers in this type of credit operation. And we can see that by taking the date of the shock in our diff and diff estimation, taking July 2019 as the shock date, we can see that beta 3 is still significant, and this is still negative, meaning that spreads for credit card anticipation are lower after the announcement of this new regulation, of this new policy. Of course, we run a lot of placebo tests to avoid spurious results, and our beta 3 parameter is still significant. So we can see that, okay, spreads are now lower after the implementation of this new registry system. We have saw that the impacts on spreads, but how about how much are the merchants anticipate? Since the cost of this type of credit is lower, are they anticipating more? So we also investigate the impact of this policy on the traded volume, on the volume of anticipation of credit card anticipation. So here we have a temporal evolution of the volume, or anticipation volume. The orange one represents our control group, the other type of credit, and the blue one represents the volume of credit card receivables anticipation. And we can see that there is a huge increase on this type of credit, meaning that merchants are anticipating more as the cost is lower. So essentially, we estimated our diff and diff equation, but now replacing our dependent variable replacing the spreads by the volume. So here we have 4 different specifications that our coefficient of interest, beta 3, is still significant, but of course now it is positive, meaning that relative to the control group, the volume, the anticipated volume for credit card receivables discounting are higher than the other type of credit. So merchants face a more cheaper way of anticipating, and also they are anticipating more since it's more advantageous to this type of merchants. So we also, to finish, we also investigate, okay, but how about the potential benefits of this policy? Here we took a numerical exercise to evaluate essentially how much merchants are saving in terms of interest rates payments due to the creation of this new registry system. And essentially we took the average spread 2 months before the creation of the registry system, and then took the difference between this average with the current spreads and multiplied by the traded volume to have a metric of how much they are saving after this new policy. And we can see that over time there is an increase of the economic benefits, and by summing up of these benefits, it can achieve around 27 billion reais until September 2024. So now the merchants can use these funds to invest on their own activities since they are anticipating more. So finally, to provide the conclusion, the basic idea here was to investigate the potential of this new policy by the creation of these new registry entities in Brazil. We showed that there was a decrease on the cost of this type of credit. So credit card anticipations are now cheaper after the creation of this new registry system, since there is more competition in this market, and also they are anticipating more, so we can achieve economic benefits in terms of interest savings. As future research, we are trying to investigate how this market is related to economic cycles, how about its resilience to variations on macroeconomic variables, and also to disaggregate the results in terms of the size of the merchants, which means which type of merchant beneficiates more with this new registry system. So here I have some references, and thank you very much for your attention.
Thank you, Leandro, for your light presentation. So I'd like to invite Tong Yu from Imperial College London to comment the presentation.
Great. So thank you for inviting me to discuss this paper, and I really enjoyed reading this paper. So actually, in the first place, I got the Portuguese version of this paper, but I don't understand this language, but a professor just sent me the English version at the right time. So which means I learned both version. Like from Portuguese version, I learned the language, and for the English version, I learned the new knowledge. Okay, so this picture shows how does the receivables register work. So first, there's a customer, and the customers purchase goods via the card. So there's the payment record. And these records go through the merchant. And then the merchant transfer these card transaction data to the card acquirer. And the card acquirer can put or can also transfer these receivable data to the register. And then the register can check the receivables when the borrowers go to the lenders. And if the receivables is there and everything about this collateral is okay, then the lender can grant the loans, business loans to the merchant. And these loans secured by these receivables. But definitely, I think your slides have a more beautiful version of this. Yeah. Okay, so summary is this great paper, and this paper studied a very important question. How does receivables register affect credit market? They used the approach that there are two regulatory changes in Brazil in 2019 and 2021. And then the authors used the DID settings to compare the credit card receivable discounting product with the other products. And the data is also very cool. That is monthly data at the credit product level from the BCB. And the main findings is that the credit spread decreased by 9 percentage points, and the credit volume increased by 76%. And also, there's a spillover effects on the consumer credit market. That is the credit spread dropped by 7 percentage points. So actually, this is a really cool thing, right? We see the price down and the pie grows. And my evaluation is this is a great paper. It shows how important the transaction data, like this is kind of a open banking, right? How important is it? And this also has a great policy implication because this data sharing may have impact on the market competition, right? There could be new lenders, like fintech lenders. And also, they could also have a huge impact on the consumer welfare. Well, in my opinion, I have two comments. So one comment is about the empirical design, that is specifically about the econometric specification and the pre-trend assumption. The second comment is about the in-depth analysis, that the heterogeneity, mechanism, the market dynamics, etc. So, comment 1.1, econometric specification. So basically, this paper used a basic DID specification. This is very standard. And the Y represents the dependent variable that at the credit product time level. So which means it assumes all types of credit products have the same volume or same significance. Well, is this true in reality? I suppose not. So if that is not the case, then the estimate of the real impact may be biased. Well, there's a very quick solution, that is, use a weighted specification rather than the average weighted specification that would give a more realistic and more econometrical and meaningful results. And my second comment, my comment 1.2 is the parallel trend assumption. So this gives the figures about the 3-month average, moving average, the credit spread from 2011 to 2024. And you can see that the red line is the treatment group. That definitely there's a decrease in trend since 2011. While for the control group, it is a relatively stable trend, right? So the reason I'm thinking it could be because the control group is just using a very simple average weighted approach. So if it uses like the weighted approach by the volumes, then it could be matched before the policy. And also the ideally, I would like to see a picture like this one. So this one is published in AR, and I think that is a very nice picture. I always want to use like picture to in my papers. So basically, it is the event studies for different periods, DID estimate. And so the potential solution to the parallel trend would be constructing the control group using a weighted approach plus this dynamic DID specification. And of course, there are loads of studies about DID, right? So you can see from my left-hand side chart, the state-of-the-art DID literature is like that. While my understanding of the DID is just a very thin, so maybe my comments could be biased, but I definitely would recommend this paper. So this is a recent DID paper read by all those scholars. They are working in the frontier of the DID literature, and I also have been told like this is a very cool paper. And comment 2 is about the in-depth analysis. So current version only shows the aggregate product level data, and that it is limited in interpreting the impact. So there's huge opportunity for the deeper analysis, like the heterogeneity analysis. For example, the small firms versus big firms, young firms versus old firms, and firms across different sectors, locations. So they are really important questions to study. And second, what is the underlying mechanism? So why does exactly the spread is reduced? It is because the land data have more information, so it can do better screening or something about the monitoring. We don't know. And also, there's a huge impact on the credit dynamics. For example, which lenders they drive the competition, the banks or fintech lenders, and who increase lending volumes, who reduce the interest rate. I think those are loads of very important questions, and the solution is find a granular data that is firm level, transaction level, or loan level data. So overall, this is a great paper, and I really enjoyed reading it. And this paper looking at the implementation of the receivables register in Brazil, and it exactly provides an economic rationale for open banking, which is my paper I will present like in next 5 minutes, and data sharing matters. With a more granular data and tightening up the identification strategy, I believe this paper has a great potential to be published in a top journal. And everything about open banking, open finance, the data sharing, the receivable register, they're very cool and very exciting area. And I believe there's much more to be done. Yeah, so that is my discussion.
Thank you, Tom, for your great comments. Leon would like to react.
Yes, sure. Thank you, Tong, for the very specific reading. About your comments, I agree with all of them. Very nice. Regarding the parallel trend, we have performed some tests, and when we have all the credits together, not the average, we can find a parallel trend. But of course, by weighting with the volume, we'll be provided more robust results. And that's, we have this kind of information about the volume. So thank you very much for this insight. We will consider it. And also, we about the use of a dynamic definitive specification. Of course, this is a first version of this paper, and of course, we are going to try some more robust specifications for our equation. Regarding the disaggregating the data, this is a thing that we want to work on it, but it's very hard to find the data, this disaggregated data. So actually, we are hoping that BCB can share the data with us, so we can perform the analysis. So in general, thank you very much, Tom. Thank you.
Thank you, Leandro. I'd like to open to the audience. If anyone has any question, please feel free to raise your hand and open the microphone. Please.
Very nice paper. I wonder whether you could try to explore more the mechanisms that the discussant mentioned. You state very clearly two mechanisms. One is the strength of the collateral, right?
Yeah.
Less space for fraud, and another is competition.
Yeah.
So you are an expert on receivables, so you might know ex ante in cases where fraud was more of a concern versus cases where lack of competition was more of a concern, and investigate if the effects, if the decrease in spreads, how do the decrease in spreads happen in comparison, relative comparison to these cases. I don't know what type of heterogeneity would you explore, so the type of institution, the type of the original provider of the credit, I don't know. Have you thought about that?
Actually, you have a lot of ways to anticipate credit card receivables. You can anticipate without transferring the ownership to the financial institution, for example, and you have the way by transferring the ownership. And for this type of credit, you have different spreads involving the operations. And we don't have the disaggregation of this data. And also, another problem is that the problem with chargeback. Sometimes you can anticipate, but you can also have a fraud involving chargeback. And actually, not all the type of frauds can be diminished with the creation of this registry system. So there is other mechanisms to evaluate in which case, but in that case, the evaluation of the lender will be defined how much will be the spreads involving the operation. But I think that's it.
Anyone? Please.
Good afternoon. First of all, congratulations on the paper. It's very relevant and timely contribution. I just add that installment peaks in Brazil could also open a big opportunity for receivables anticipation. As PIX moves into credit and installment features, this could be a natural next step. And I'm with PagaLeve, a fintech that work with that. So we are closely watching this potential market. It's an area we are following closely. So we are eager to contribute practical insights as this market develops.
Okay, thank you very much.
Just a quick question. So thank you for the paper, great paper, great explanations. I just have a question. When you're analyzing the data related to CERC, that once the CERC came in, was able to reduce the spread, do you also consider that we had a large increase of competitors into the market in Brazil, and that probably was one of the key contributors? And then also the entrance of PICs was quite disruptive and was able to also bring the spread down.
Actually, we work with the aggregated data, so it's not the data from CERC. It's for all receivables registries. And of course, we we don't have access to this type of data, but of course, we can evaluate what is the impact, for example, the peaks on this type of anticipation. Thank you.
My question is not specific about your paper, great paper, by the way, but I was wondering which are the pros and cons of having more than one registry entity in Brazil, because I think we already have, right? So I would like to know your opinion about that.
Actually, today we have 4 major registry systems, entities in Brazil. 2 of them have the more representative market share, which is Nuclea and CERC. CERC is more representative in terms of number of merchants that register on its registry system, and Nuclea has the more market share in terms of volume. My opinion is that we can have more than one registry system. I don't think why it's necessary having a lot of them, because we have actually a few number of acquirers in the country. So in general, they have the registry operation especially with only one, but sometimes the acquirer have with more than one registry. And I think that this is the current market structure and it's working. By having more, I don't think that it will improve the transparency, maybe the transparency or security of the system. Okay, thank you.
Anyone else? I would like to make a question make a link with the gene research. Have you identified along your research a difference between spreads, rates, practiced by the inside banking or the outside banking, or inside financial institution, the outside financial institution?
No, unfortunately, we don't have the access to this disaggregated data. And especially another limitation of this work is that the spreads for credit card anticipation that we took in the central bank's website is from financial institutions, so they are even more aggregated. So by having access to disaggregated data, maybe we can evaluate that.
Sure. Thank you, Leon. So to the next presentation, I'd like to invite Tong Yun from Imperial College London to present his research data as collateral open banking for small business lending. Please.
Okay. So thank you for your kind introduction, and I'm very delighted to be here. And I enjoy especially the lunch and the food and the snacks here. Okay, so today I present my research paper, Data as Collateral, Open Banking for Small Business Lending. So data and collateral play a crucial role in small business lending. Lenders typically assess a firm's creditworthiness by looking at the financial history data. But the problem is, this data or this information is usually locked away with a bank that provides the firm's current account, and therefore it's not widely shared. So this creates an information asymmetry between the firms and new lenders, forcing small firms to rely heavily on collateral to secure loans. But there's another problem, right? Unlike larger firms, small firms often lack physical assets like real estate to serve as collateral. So this leads to collateral constraints, limiting the access to credit and hindering the growth. In this paper, I study a fintech innovation called open banking, which allows bank customers to share the financial transaction data with the third parties, like fintech or new lenders. Because of this data sharing, open banking has the potential to mitigate these financial frictions that I mentioned before. Many small firms rely on a single bank for financial services, meaning that the bank financial data can provide a rich picture of the operations and financial situations. And open banking can transfer that ownership of that data from the banks to the firms, allowing them to share it directly with the new lenders. So this is super cool, right? Because it's data sharing. And what we already know is that from my paper co-authored with Tanya and al., so that paper is now published in the Journal of Financial Economics. So we find that open banking improves small firms' access to credit. But what we don't know is why. So we don't know what is the underlying mechanism. And this paper exactly provides an answer to this. So why does open banking, this data sharing, improves small firms' access to credit? Does this related to mitigating those financial frictions that can open banking mitigate information asymmetry? How does open banking impact loan collateralization? To address these questions, I exploit the UK's small business-focused open banking. This policy requires 9 leading UK banks to share their small business customer data with the new lenders or new banks. And importantly, this policy applies only to small firms that with revenue up to £25 million. So this creates a quasi-random assignment of the firm's eligibility to share that data. And because of this unique setting, I can use a sharp regression discontinuity design to study the causal effects of open banking. Using a comprehensive data that's covering nearly the universe of UK firms and capturing the entire UK secured business loan market, I find that open banking facilitates the use of assets like accounts receivable and inventory as collateral. So these assets, they were previously seen as too risky or too difficult to monitor, but now we have open banking. The lenders are more willing to accept these assets as collateral. Firms eligible to share the data are about 4 percentage points more likely to pledge such assets as collateral. And also find that there's no impact on the use of fixed assets like land, property, or equipment. And the effects of open banking are more pronounced for firms with great information symmetry and for those with great information available to share. So overall, these findings suggest that open banking reduces collateral constraints by mitigating information symmetry, which in turn improves access to credit. And this paper contributes to several strands of literature, which I will skip for the interest of time. Before diving into the research design, I'd like to give a more institute background about UK, because the UK setting may be different to the Brazil or the other countries. So in UK, most small business loans are secured by 2 types of collateral. So one is floating liens, another is fixed liens. A floating lien covers the general categories of assets, for example, accounts receivable and inventory as a whole. So these assets, the value and the quantity can actually fluctuate significantly over time. And most importantly, they can be sold without the lender's permission. In contrast, a fixed lien is tied to a specific assets, like fixed assets, land, property, equipment. And these assets they usually have stable and predictable value. And most importantly, they can't be sold without the lender's permission. And so even though, like for most small firms, because they are small, they don't have much fixed assets. What they have is just accounts receivable and inventory and other current assets. So, but still, using these current assets is a challenge for them. So in my data, only 6% of those small firms, they are able to use current assets like accounts receivable and inventory to secure loans. And also I find that the size, the correlation between the size of fixed assets and the use of fixed liens is significantly positive. But there's almost a zero correlation between the size of current assets and the use of floating liens. So in other words, having more current assets doesn't really increase a small firm's chance of using the floating liens to secure loans. So why is this the case? Well, there are two possible reasons. So one, because current assets, they are volatile and hard to predict. So this leads to an adverse selection problem, right? Because the firms with lower quality or highly volatile assets are more likely to seek credit. There's also a issue of moral hazard, because the assets on the floating liens, they can be sold without the lender's permission. So which means the lenders don't know whether the borrowers misused or turned out these assets. As a result, without up-to-date and the detailed information about the firm's transaction or its operations, the lenders will not be able to accept these current assets as collateral. Well, this is exactly where open banking can make a difference. By providing a better visibility into a firm's real-time financial data, the open banking has the potential to mitigate these these information asymmetries. There are two roles of open banking. So first, it can enhance the loan screening, because open banking provides a better understanding of the borrower's creditworthiness. This substantially improves the default prediction, and which thereby reducing the perceived risk. So this reduced or mitigate the ex-ante information asymmetry, that is the adverse selection problem. Second, open banking can facilitate the ongoing monitoring, because open banking gives access to those financial data even after the loan has been approved. So this allows the lenders to monitor the ongoing cash flow of the borrowers more effectively. So this mitigates the ex-post information asymmetry, that is, mitigate the moral hazard issue. So because of this, data shared through open banking can mitigate both ex-ante and ex-post information asymmetry, so it can be seen as like a digital collateral, but not a physical collateral. And this idea is similar to Gosh, Veli Zhang, the Jeff paper. So basically, they argue that the cashless payment records can function as a digital collateral. So, but empirically, identifying the causal effects of open banking is a challenge. There are three reasons. So one, we need a setting that clearly shows which firm is treated by open banking. Well, to solve this issue, I used a UK small business focused open banking policy, because under this policy, only small firms with revenue up to £25 million, they are eligible for open banking, which means they are treated. The second change is the information gathered through the lending relationships can also affect collateralization, right? So to address this issue, my paper focuses on the collateralization on the loans from new lenders rather than from existing or relationship lending lenders. Third, firm characteristics and credit demand can also affect the collateralization, right? So to address this issue, I use a sharp regression discontinuity to around this £25 million threshold, because firms just below and just above this threshold, they should be very similar. And any jump in the outcome variable can be attributed to open banking. And for data, I've got a unique administrative data set through my affiliation with the Financial Conduct Authority in the UK. So basically, I worked 2 years there for this data. So this includes the loan level data from the company charge register. It captures universe of the UK secured business loan market. And second, fund level data that from the interdepartmental business register. So it's covering the universe of UK firms. And also use other data like BVD data, the postcode lending data to supplement my analysis. Okay, so the key identifying assumption of the RDD is that in absence of open banking, all relevant factors very smooth across the cutoff. So to support this assumption, I run a covariant balance test. So basically, I run this test on 6 predetermined firm characteristics, like the log of total assets, the leverage ratio, cash holding, current assets, bank overdraft, and trade credit. So all these graphs shows there's no statistical evidence of the discontinuity around the cutoff. Another assumption is people may argue that the firms, if they know the benefit of open banking, then they maybe want to manipulate the revenue below this threshold. So to solve this concern, first I plot the histogram of the running variable, which you can see that there's no significant bunching around this cutoff. And also I do a density test following the literature, which tests whether there's a discontinuity of the density of the vulnerables, and it also shows there's no discontinuity. So all this shows there's no statistical evidence of discontinuity, of manipulation. Well, people may still argue there could be still the case that firms can manipulate the revenue, like some large firms in the real world. Actually, there's some corporate fraud or scams, right? Well, in my setting, this is not the case. Why? Because there's a trade-off. Okay, suppose to some extent, the more revenue you have, the higher probability of getting credit, right? So if you want to report less revenue, which means your probability of getting credit becomes lower. So that is a cost. So you can definitely benefit from manipulation to be eligible for open banking, but there's a cost of a lower probability of getting credit. So because of this trade-off, I can say that there could be very limited manipulation of the revenue. And this graph shows the main findings of my paper. So basically, from the left-hand side chart, that shows a significant discontinuity around this cutoff. That is, open banking facilitates more use of floating liens as collateral. On the right-hand side, there's no discontinuity, right? So, which means open banking doesn't affect the use of fixed liens or non-floating liens. So this shows open banking reduces collateral because without open banking, the lenders not willing to accept those floating liens. But with open banking, those borrowers are more likely to use those floating liens, which significantly reduce their collateral constraints. And also I studied the dynamic effects. In absence of open banking, the firms just below and just above this threshold exhibited a very similar pattern in the use of collateral. And besides the covariant balance test and the manipulation test, also conduct a battery of tests like the placebo cutoff test, do not hold test, bandwidth sensitivity test, and also a robust check about the RDD specification. So basically, I run 96 different models of RDD with the different combination of the specifications. And this basically shows my result is robust across all the models. Okay, so why does open banking reduce collateral constraints? I propose 3 channels So one, information channel. Second, computation channel. Third, lending technology channel. So for the information channel, I use the firm age as a proxy for the financial frictions. Because young firms, they usually have a short record, right? Which means they have a great information asymmetry. And I find that the young firms are more significantly impacted by open banking. So which means open banking reduces collateral constraints for those with great information asymmetries. Then I also look at the firms with or without prior lending relationships. So because the firms without prior lending relationships means they have a thin credit history, which means they have great information asymmetry, right? And we find that the firms without lending relationships, they benefit from open banking. So this also argue that the open banking promotes financial frictions because those previously underserved small business, they now, because of open banking, they can have access to credit. And more interestingly, I also find those firms with prior relationships, they also benefit from open banking, right? So this is quite strange in the first place. Then I look into the intensive margin of these prior relationships. That is, I split the firms with the prior relationships with CCDS lenders and those with non-CCDS lenders. So the CCDS lenders are those large banks that are required to share the data. So if you have a lending relationships with CCDS lenders, which means you are more likely you have a bank account with those CCDS lenders, which means you have more information to share through open banking. So I find that firms with prior relationships with CCDS lenders, they're more significantly impacted by open banking. So basically, this says open banking reduces collateral constraints for those with great information available to share. I also look at the competition channel that I find the firms located in competitive market are more significantly impacted by open banking. And third channel, lending technology channel. Well, there's an alternative story, right? Because the different lenders, they may have different technology to process the information shared through open banking. So for example, on the one hand, banks, traditional banks, they may be more familiar with those bank statement, bank transaction data, right? Because they are the holders of these accounts. On the other hand, like the non-banks, like the fintech lenders, they may have more advanced technology to process this information, so which means they could be more effectively to process information shared through open banking. But what I find that is there's no strong evidence shows that there's differences in lending technology channel, in lending technology can drive the result. So basically, for both loans from the lenders, from the banks and non-banks, they both benefit from open banking. Okay, so why does open banking reduce collateral constraints? Information channel works, communication channel works, but the lending technology channel doesn't work. So this is a last piece of my empirical results. So basically, I find that open banking increases the number of new jobs, but it doesn't really increase the number of new establishments. So in other words, the effects of open banking manifest through the manifest through the employment growth within the existing establishments rather than through the expansion of new establishments. To conclude, so this paper put together a novel data set covering the nearly universe of UK firms and capturing nearly the entire UK security business loans. And I find that open banking eases the pledge of assets like accounts receivable and inventory as collateral. Firms eligible to share the data are more likely to use these assets to secure loans. So we know that open banking, this is the data showing, it definitely reduced information asymmetry, and we also know that the access to credit improved. But what we don't know is the underlying mechanism, and this is exactly the key takeaway of my paper, that my paper shows open banking reduces collateral cost trends by mitigating information asymmetry, which in turn improves access to credit. And as of October 2024, there are about 87 countries in the world accounting for 95% of the world's GDP actively or have already implemented open banking framework or open finance framework. So this is a huge thing, right? Because this is a global phenomenon. And myself and my co-authors, we are actively pushing the research agenda of the open banking and open finance. And I know there's a huge opportunity in Brazil here. You have a more advanced technology like the open finance framework and the PIX payment system. And I'm looking forward to any opportunity for collaboration in the future. And you have questions or comments, just let me know. Yeah, thank you.
Thank you, Tom, for your great presentation. So I would like to invite Jinkao to make comments about the work.
Hello, everyone. So I would like to thank the organizers to let me discuss this great paper. This is a very well-written paper, and I enjoy reading quite a lot and really learned quite a lot. I know I'm standing between you and the dinner, so I will be concise with my points. So first, as we see, Tong has done a great job in the presentation. So let me quickly wrap up what the paper tells us. So the paper investigates the effects of open banking on collateralization by exploiting the discontinuity in the borrower's eligibility to share data. And the key message is the eligible borrowers, they are more likely to use the floating liens as data sharing facilities ongoing monitoring. And this provides the credible value of the floating liens for the lender. And in contrast, there's no impact on the use of non-floating liens because there's no such information channel on the non-floating liens. And the effects are driven by borrowers with shorter credit records, pledging information-sensitive assets, and with prior banking history to share. So overall, this is a very well-written paper with a highly important insights. As we in central banks, well, we are always trying to push everything to eliminate the information friction, and the author thus provides the first evidence on how open banking can help the market competition to improve. And the research is based on great data with very carefully executed empirical analysis. So I would like to congratulate Tong for having such a great paper. So I have a few comments. Some of them are major, some of them are minor. So let's start with the key finding of the paper, is that eligible borrowers are more likely to use floating liens as the data sharing facility ongoing monitoring that mitigates moral hazard on the floating liens. And this is why there's no effect observed on the use of non-floating liens. So this seems to be a little bit puzzling for me, because as we learned from Holmstrom and Tyrrell, moral hazard is the reason why we need collateral, no matter what collateral, in banking, right? So to give you an example, before the open banking reform in UK, if I lend to Tong, I don't know who he is. I'm afraid that he's going to run away with my money. So that's why I ask for collateral, like the apartment in London of Tong as my collateral, right? So now, after the reform of open banking, I know that I can observe what Tong is doing with the collateral, right? I know that he's not going to run away with my money. So I should have a lower requirement all kinds of collateral on tone, right? So that basically tells us the improved monitoring basically mitigates moral hazard, and it should actually have an impact on both kinds of collaterals. So why did Tong only observe the effects on the floating liens? I guess the empirical results which are observed in the paper, if we still trust Holmstrom-Tyrrell, is probably a mixture of expanded eligibility of floating lien and a reduction in collateralization. So the consequences of open banking reform might include a very complicated consequences. For example, the reduced collateral requirements enables constrained borrowers to start borrowing or borrow more. So this would increase the usage of both floating and non-floating liens. But on the other hand, reduced collateral requirement enables borrowers to opt for unsecured loans because, now with the monitoring capability, I don't need collateral anymore, So for some of the borrowers, they can actually easily go for unsecured loans, and this would reduce the usage of collateral. And also expanded eligibility of floating liens enable borrowers to rebalance the uses of both type of liens, right? So I don't know whether borrowers would have a preference on either of them. So there might be a pecking order, might not be. But for borrowers, this also creates incentive for them to rebalance the components in their collateral, right? So in the end, as I can see, well, if we still believe that information sharing mitigates the moral hazard problem, the channel actually can be very complicated. It actually can happen in many ways, right? So instead of going through these complicated consequences, I think one thing that the author might do to convince the reader is you probably can test if open banking improves monitoring so that there will be a reduction in overall collateralization. Right? For example, if you can observe a lower haircut on collateral, a higher LTV ratio, and so on. So if you can observe that, basically we can believe, right, by mitigating the moral hazard, we actually have an overall reduction in collateralization. But because the moral hazard problem is more prominent for the floating liens, we actually observe an increasing use of floating liens. So I guess combining these two probably is probably going to be more convincing on the moral hazard channel. So my second comment is, if we think about the information friction in banking, there are many frictions, and open banking basically provides many opportunities to ease these frictions. So my suggestion is, it will be really useful to tell us what information is shared and what frictions actually can be eased by sharing this information. So to give you an example, in your previous paper, basically you show after open banking, the firms with prior lending relationship, they are more likely to build new lending relationships because with new lenders, after observing your prior lending history, they know more about the credit quality of the borrowers, right? So this actually is the screening procedure of the new lending relationship. So of course, the information sharing addresses this information friction, right? So that is very convincing. And if we look at your paper, basically you show by sharing the prior lending relationship, you increase the usage of floating liens in new loans. So this is, again, a little bit puzzling for me because if we think about the friction here is, why banks are reluctant in accepting floating liens is because these collateral, they are more manipulable, right? So on the procedure of the loans, you can actually manipulate your receivables, manipulate your inventories. So that is why banks have a problem of accepting floating liens. right? But to mitigate such moral hazard, you need ongoing monitoring, which actually hardly be possible to derive from your past borrowing relationship, right? So this is my puzzle. And my conjecture is, well, probably you can basically infer the capability of floating liens by looking at the past floating lien history, right? If your past relationship is based on floating liens, you probably know better about how the quality of these floating lien is. But as you said, before the reform, actually floating liens were rarely used, right? So what happens to those borrowers who had no floating liens in prior lending relationships? So how do they improve the credibility of their floating liens? So that's one question. A second question, second possibility is, well, probably after you share the prior lending history, you can also share the prior deposit history, right? So that is from your past relationship, you know what is the transaction account looks like, and even after the new relationship is built, you can still keep monitoring by looking at the transaction account. But as we know from my paper, actually a lot of borrowers, they don't have a deposit account in the same bank that you borrow from, right? So what happens to those borrowers who actually don't have a transaction account in the past relationship? So what information can you get if you want the information be useful to monitor the future quality of the collateral? That's my puzzle. And you also show that even for borrowers without prior lending relationships, they also benefit from open banking. But if you don't have prior relationships, what information that you are sharing, right? So this is all puzzling for me by reading the paper. So I guess here it will be really useful if you can tell a little bit more about what information is shared through open banking, right? And what kind of information is addressing what kind of information friction, right? So by showing this clearly, I think it will be more convincing for us to understand what friction is resolved. And my next comment is about the consequence of increasing market competition after the reform. So basically, after the open banking reform, you level the playgrounds of incumbent and competing lenders for the small borrowers, right? So the borrowers below the threshold. So that basically means that the lending market to the borrowers, they are more contestable below the threshold. So that basically means with the same information set, the competing lenders, they can actually poach borrowers from each lenders by offering better terms of loans. And knowing this, the incumbent lender, the inside bank, they have the incentive to provide better offers for borrowers, right? So that is what you observe in your paper. But if this is the case, that basically means by imposing the threshold, you actually change the market structure below and above the threshold, right? So below the threshold, the market is more compatible, contestable. The lenders are competing on the same information set, but above the threshold, the lenders are not sharing information with each other, so the hold-up problem is probably more severe above the threshold, right? So that basically leads to a question of me, what is the consequence on your RDD analysis, right? Because RDD analysis basically means introducing the threshold does not lead to structural changes, right? So what is the consequence? Of course, I'm not saying RDD is not valid, but it's probably useful to look at this issue and be a little bit more careful about consequences of the market structure change. And a minor consequence about letting letting lenders compete with the same information set is the so-called winner's curse. So if by introducing open banking, you allow all the lenders competing with the same information set, the consequence might be that under the competition pressure, some of the lenders might be pressed to accept excessively risky floating liens, right? So that basically can lead to consequences of financial stability, that some of these loans based on excessively risky floating liens might be more risky after the reform, right? So the consequence, the question from a policymaker is, well, are you able to follow the progress of the loans in the future and see whether there is any consequences on the loan outcomes for those lenders accepting floating liens. And I have some minor comments. Well, one is about the terminology. Well, I'm personally not very comfortable with the data as collateral because I'm not going to use my data as collateral. And also, in your competition channel, you have two effects, the so-called substitution effect, the competition effect. But it seems to me these are the consequences of a more contestable market in the sense of I/O. So I would try to avoid using substitution effect because this has a special meaning in the econ theory in other contexts. So it's probably more appropriate to call it a contestable market. And my last minor comment is, well, RDD is a very nice approach, and it is very nice for studying causalities, but also the restriction of RTD is you don't know much outside the narrow neighborhood of the threshold, right? So that basically means from your results, we know mostly for those firms around the threshold, which basically means these firms with revenue, annual revenue more than 25 million pounds. So that is about 200 million Brazilian real, right? So in this sense, they are not really small firms, right? So in the title, you want to study the impact of small firms, but in the end, you look at not so small firms, right? So the question for me is, well, since these firms are not that small, so if I'm a bank, well, for those firms, I actually have to be very serious about those guys because they are actually substantially big customers, right? So I have to give them what they want if possible, right? But in comparison, for those smaller firms, really far away below the threshold, the banks are probably not that serious with them, right? Because they are small, not profitable, they are risky, right? So there, the consequence of the open banking reform is probably going to be different, right? So from policy maker point of view, I want to ask, well, can we just forget about the causality, just look at what happens to these really smaller borrowers by using a simple definitive and try to see whether the consequences for them would be different or not. I think that can be interesting as well. So to wrap up, this is a paper based on great data, very careful empirical analysis to provide the first evidence on open banking reform in UK. And this is really, I would say, good reading for every policymaker. And also there are more questions for us to think about, to answer. And I wish the author best of luck with the paper, and I'm very much looking forward to reading the next version. Thank you.
Thank you, Jim. Tom, would you like to comment?
Yeah.
So thank you, Jim, for this great discussion. And my apologies. I think I'm the only reason that you stay here, and I'm the only one standing between you and the dinner. So I will quickly reply to these comments. Okay, so for the 25 million pounds, this cutoff. So in the UK, there's loads of definition of small business. So there's no mainstream, or there's no one single definition. But the 25 million pounds is definitely within the small business definition in the UK, even though it's not very those tiny, small business, but still the small business. Like in the US, the threshold is about 50 million USD. So yeah, something like that. And yeah, I think like in the for the existing lenders, because my paper focuses on the collateralization of the loans from new lenders, so that is my key part. Also, I did a empirical analysis on the existing lenders, and I will really think about your comments on this. And I think this is something about the credit market dynamics and the I/O, the structure of the market. I think it could be another paper, and the idea is really great. And for this, the borrowers without prior lending relationships, why they also benefited of banking? Because this is lending relationships, not banking relationships. Even though they don't have any prior relationships, they can still have bank account. They still have something to share. So that is the key point here. And yeah, so I think this is a great suggestion. Like look at the overall collateralization, like the haircut on collateral, the LTV, and maybe the interest rate. Well, the limitation is the data limitation. So at this moment, I don't have access to those very detailed data. And the FCA, indeed, they have the interest rate data, and because the interest rate is kind of like commercially sensitivity, so I'm still applying for the interest rate data, and I hope I could incorporate the interest rate data in into my next version. Yeah, and why there's no impact on, like, no floating limbs? Well, the reason is very simple, because the most firms, they have already pledged their fixed assets. So even though now with open banking, they don't have other fixed assets like land, property, equipment to use as non-floating limbs. What they only have is that the account receivable and inventory that can't be used as collateral previously. So that's why there's very limited or there's no effects on the fixed or non-floating limbs. Yeah, so basically I think if you have, yeah?
I have a question. So Jan Skrsnić from WashU.
Yeah.
I have a question which kind of resonates with the discussant. So in some sense, the collateral part is kind of redundant. So it seems like your model is about information asymmetry.
Yes.
And from theoretical point of view, you're just thinking about on which kind of credit is this information asymmetry more important. So I'd assume unsecured is one extreme and super secured is the other extreme. So what you have there is just in between, and it just happens that banks ask it. So it seems like it should be a second order effect. Your first is just thinking about pitching it an information asymmetry problem. And then the second one, I didn't really see there. Is there, in your results, is there a total increase in lending? They're within firm estimate across time. I couldn't see that because that seems the most important outcome that you want to show. And the third one, is the 25 million cutoff really binding also for the firms above? Because I would imagine if I'm a bank and you say 25 million, I would probably also go with 25.3 because, in case that suddenly becomes like eligible because of some accounting issue. So that would mean an underestimation on your setting. Thank you.
Yeah, so for your second one, it is about the manipulation revenue, right?
That's no manipulation, it's just bank just shares information. Like in Brazil, banks share information way above, above the threshold.
Okay, so basically, the banks, they are not willing to share this information. Why? Because they already the information monopoly, so they have no incentive to share this data.
Well, but 25 million one year might be in accounting rules next year restated differently, which might mean that they should have been shared, right? So banks have risk aversion. That's all I'm saying. There's nothing manipulation.
Yeah, so basically, I can't say I can't see exactly the revenue for the firms that are actually sharing the data, but yeah, I think this is what I know. Yeah. And for the second question, the overall lending, so the RDD is studying the local effects, right? So it's definitely not telling the whole picture, the story about the whole picture. Well, my previous paper, coauthored with Tanya, so that paper we look at the average effects, which is more related to the overall lending. So we find that those treated firms that is below this threshold, as a group, they have access. They are more likely to have access to credit. So I think this is something related to the overall lending. And for your first question, is about the collateralization, right? The type of collateralization. So for the UK, most small business firms, their loans are secured. So it is just about whether they're using the floating liens or non-floating liens. So they really have like limited loans secured by, like not secured. So that's why I just study the intentional margin of this collateralization. Do I answer your question, Deborah?
Roughly.
Thank you. Yeah, please.
Hi, Tom, very
Yeah.
nice. Thank you for the presentation. I congratulate you for the very nice paper. Also, Jean, very nice discussion. I had a comment on this kind of preliminary observation you presented at the beginning of the presentation, showing that there is no apparent correlation between the assets, right, and taking in this floating liens. And then you were connecting this to market frictions, adverse selection, moral hazard. I thought like one kind of alternative or complementary explanation is the complexity of this product and its operational complexity. I don't know, it's more like a question, but I will not expect all banks to offer this service because of how complex it can become. You can actually moderate those risks with loan covenants, for example, but again, using loan covenants makes the whole process more complex to manage, right? And to follow up on this and to control this and keep the track of what the firm is doing with the assets, right? With the pledge assets. And beyond these comments, I was thinking, is this important in your analysis? So maybe yes, because maybe this implies that despite the fact that open banking lowers certain frictions, we still see, hypothesis here, because I don't know, that actually the same banks that were operating in this market before are the ones that benefit the most from this alleviation in the friction, and that there are not too many new banks really making use of this. This is more obviously a question because I don't know. So that's a comment. Do banks kind of change their behavior vis-a-vis this market, or are these simply the same banks that are participating in the same product, but with more firms, right? Thank you.
Yeah, so basically, this result shows the equilibrium result. So I can't identify whether this is changed from the supply side or demand side. So, so basically, I think this must have something to do with the operation, right? Because if now it has open banking, they actually can facilitate the process of the underwriting, right? So, but I don't have any data or something to distinguish that from my hypothesis on the moral hazard or on the ongoing monitoring that part. Yeah. Yeah.
Yes, congratulations on the paper. Just, I mean, looking at what you find, the results, which are really nice. If we look at the Brazilian reality, sorry? No, okay. If we look at the Brazilian reality, most firms do not access the credit market. And banks prefer personal collateral. So they prefer to lend to individuals, the owners of the firm, and then the owners finance the firm. So if we find what you find in Brazil, this seems that like the effect of the open banking initiative is way bigger than what you find. So on one side, maybe you're showing the lower bound results of open finance, open banking effects. But on the other hand, what we see is that together with open banking, we had also a lot of information sharing, public information sharing. And this goes, I mean, it's public to all different institutions. And it's in a moment that you have many fintechs entering the market. And even if it's like a fintech or a bank, it's like a kind of like, no matter if it's like a market with more or less competition, institutions are kind in a rush to gain market share or not to lose market share, right? So it's kind of like we have to lend more, we have to, and if we don't have like the right models to process this new information or the public information, we will outsource it or we will improve our models. So I'm just wondering if like the channel that you're not seeing at the moment, maybe it's still present, but the way you're trying to analyze it, it's just, you don't see the effect, but it's there. And given that it's, the whole market's changing, so I don't know, just to have your take on these two different things that can work at the same time. Thanks.
Yeah, so basically, I definitely agree with your idea. So definitely there are loads of factors or channels in the open banking. And like in my paper, I show the competition channel, but that competition is just a, is just a geographic competition rather than the competition you mentioned, like the fintech, the new banks, and the old banks. And I think because at this moment, myself and my co-authors were trying to build a quantitative model a new model about the I/O of the credit market, the competition of the credit market due to the impact of open banking. So we're still exploring the right way to pin down that effects. But I agree that competition is definitely a very important factor in open banking or open finance framework. Yeah. And also, I'd love to talk more with you about this idea. Yeah.
Yes.
Thank you.
Please. Okay. My name is Sergio Leão.
Hi.
From Central Bank of Brazil. Yeah, one thing I guess it's not completely addressed in your presentation. Congrats for your presentation. It's a very interesting paper. I guess you pinned down exactly what open finance was intended for. They wanted just to reduce this problem of information asymmetry for those firms that don't have collateral. If you have collateral, you borrow against collateral, no problem at all. Mm-hmm. But the problem, if you don't have collateral, what happens? And you show with these floating liens firms that, wow, if the firm can provide the data to another bank, there is no problem. It reduces this problem of information asymmetry. And I think when I see that, what I'm seeing is that, on the other hand, open finance is just killing the lending relationship technology. And what's the impact of that? You see that the firms already in place increase the number of, you have a positive number of workers, I guess. They expand after the open finance introduction. But what happened with the other firms that are not already in place? Can you just look at, wow, the entrance of firms are those firms with no good collateral, these floating liens collaterals, they are less entrant for that type of firms compared to the firms that have better collateral. It would be a good I think, statistics. Because the problem is, when you think about lending relationship technology, we think the bank is just incurring a cost, helping the firms, small firms, the firms that are entering the market, and they gain that information. And for the monopoly of that information, they will extract rents exposed in order to compensate the cost incurred. And it's not on place anymore. So what's happening with the entrant firms? I think that's one good thing. And another one is I see this open finance improving monitoring. But again, improving monitoring for the already established firms. But no one, I think, would pay the cost to monitor. Because if I pay a huge cost monitoring the client, all the other banks will have this information. So I think a good, an obvious consequence would be just firms start more lending relationships in a form of risk sharing. No one is just paying the monitoring cost, but they are not going to provide all the funds that the firm needs. So the firm would need to have more lenders to provide their funds. That would be, I think, another consequence of this. So yeah, that's the contribution.
Yeah, and thank you. I think these are very good comments. So for your last comment about monitoring, I think, so at this moment, I don't have the data on whether the banks or the new lenders, they did the monitoring, but the cost is very, very small. Because this data shared through open banking, there's no cost on the new lenders or on the borrowers, but there's a cost on the existing, on the banks that provide the data. So that definitely, because that data, the banks have to arrange the data transaction, the transaction data to the credit bureau, and the credit bureau will standardize this data, and this data can be shared with any new lenders without any cost. And this can be do like ongoing monitoring for ongoing forward. Yeah, so basically, so a very limited cost for monitoring. And for the second question, what the impact on the entry firms? So like in my setting, like I studied the firms around this 25 million pounds. I believe there's no like entry firms they have can have such like higher revenue, right? So yeah, definitely I can study what the impact on that, but that couldn't be like I can't do it like as like cause effect because there's no real counterfactor on these firms, right?
I guess you can compare for those firms that have good collateral, the non-floating leads.
Yeah, that's your first question.
Yeah.
Yeah, so for your first question, so can you define what is the good quality collateral?
You have two
like floating and
floating and non-floating.
Yes,
yeah.
Yes.
I guess you can compare those kind of firms that have non-floatings with floating liens, and then compare the interest of these two groups after the introduction of that.
Yeah,
it should be different.
Yeah, I think I can definitely do that. So in my like heterogeneous analysis, yeah, I think these are very great comments.
Thank you very much. Unfortunately, our time is over. So on behalf of Central Bank of Brazil, I'd like to thank you all researchers to submit your fantastic papers to our conference and to present to us. Thank you so much.
Send me your slides. Yeah. I will send you email. Yeah. I will send you email.